I shared this amazing option strategy a couple of weeks ago, which had a 91% win rate and $176,000 in total profits. I also shared this trade idea, which is now up $1,715 or 27% in just 2 weeks. And I also got a message from a member in our private community who took this trade after watching the video, and he's up $1,743 on it and made 28% profit in just 2 weeks. And in this video, I'm going to share an even better strategy with 96% win rate and $180,000 in total profits. My name is Ravish. I've made millions of dollars in trading profits using strategies like this, and I share strategies like this for completely free on this YouTube channel. The strategies I share on this channel are even better than other people's paid $5,000 courses. So if you like this video, don't forget to hit the like and subscribe button so I can share more strategies like this with you. In this video, I'm going to share two mechanical options trading strategy with 96% win rate. They're both easy and beginner friendly. It is set and forget and does not require day-to-day trade management, no watching charts. The strategy number one made $88,000 in total profit, and strategy number two made $91,000 in total profits. Both of them combined made $180,000 total profit over the last 5 years in the backtest. For this strategy, we are only trading one ticker, which is QQQ, which represents the top 100 NASDAQ companies. This video is for education only, and I do not recommend any trades or strategies. This is a rule-based systematic strategy. My trade outlook for these trades is typically 3 to 4 months. The data says that QQQ moves up 5% or higher in 85% of the quarters, and it has a 10% upward move in 50% of the quarters. So LEAPS can make 50% profit when QQQ moves up 6 to 10%, which happens in most of the quarters. I just have to follow these simple rules, and once I open the trade, it is completely set and forget. I do not have to manage it day to day. It only requires a monthly trade management. This is a rule-based systematic strategy where there are no emotions involved. We are just relying on the data and these rules. For the first strategy, there are two rules. The first rule is that we will open a trade when QQQ gaps down by at least 1%. If you saw my first video, it was based on just this one rule that I will open a trade whenever QQQ gaps down by at least 1%. But in this strategy, I'm adding a second rule which says that QQQ should be above 100 days simple moving average. So it must meet both these rules, that QQQ should open in red at least 1% down in the morning, and the SMA should be over 100. This kind of setup typically occurs on pullbacks in a bull market. This strategy made 53 trades over the last 5 years. So we are only making about 10 trades every year. To open this trade, I'm going to buy a 60 delta call with 12 months expiration. And once I open this trade, it's going to be completely set and forget for me. The only thing I need to do is take profit at 50%. And there is no stop loss on this trade. Here are the backtest results for the last 5 years for this strategy. It made $88,400 in total profit with a win rate of 96%. It made 53 trades in total and it won 51 of them, and it only had 2 losses during a 5-year period. And the profit factor for this strategy is 10.48, which is amazing. And the win-loss ratio is 0.41. The average winning trade made $1,900 in profit, but the average loss was $4,600. But since there were only 2 losses, this strategy is still very profitable. On an average, the trade duration was 102 days, which is just a little over 3 months. If you look at the monthly chart on the right, you can see that it won trades almost every month. It only lost 2 months during the bear market of 2022. It had a max drawdown of 9,330, which is half of the drawdown of the strategy I shared in the first video. That strategy had 18,000 drawdown. In comparison, if you were to buy and hold 100 shares of QQQ, it would have had a maximum drawdown of $16,500 in 2022. The second strategy is also very similar, but it has a slightly different rules. For this strategy, the trade entry is going to be based on a single rule, which is when QQQ gaps down by at least 2% in it. So we just have to follow one rule, that in the morning when the market opens at least 2% down, that is the day we are going to open this trade. And this happens very rarely. It usually happens when the market is falling a lot, and it typically happens on a capitulation day. And from there, we usually see a good recovery over the next couple of months. There were only 27 days over the last 5 years where we had a 2% or more gap down. To open a trade like this, we are just going to follow the same method. We are going to open a 60 delta call with 12-month expiration. But in this case, because this kind of setup occurs very rarely, instead of one, I like to buy two contracts. And the profit target is also exactly the same, which is 50%, and there is no stop loss. Here are the backtest results for the second strategy. It made $91,000 in total profit, and the win rate is exactly the same, which is 96%. But this made 27 trades, and out of that, it won 26 trades and lost only one trade. The profit factor for this is higher, which is 15, which is amazing. And the win-loss ratio is also better, which is 0.06. And the max drawdown is also much better, which was only $6,000. So compared to the first strategy in my previous video, it is 1/3 of that drawdown. And compared to buy and hold triple Q, it is $16,000 versus just $6,000. The average winning trade made $3,779 in profit. And there was only one loss, which was $6,328. And if you look at the monthly performance, just one losing month with one single loser trade, and it made profit every single month over the last 5 years. Both these strategies work really well. I typically like to combine both of them, but there is one major drawdown of this strategy, that it only works in a bull market. So if we are in a long-term bull market where we get opportunities to buy the dip, that is when this strategy performs really, really well, which has been the case for most of the last 10 years. But in 2022, which was a bear market for more than a year, that strategy did not make profit. But the rules we added into this strategy eliminates most of the trades that occurred in that period. So it prevented us from going in heavy during a bear market, and it made us profit when the market was in an uptrend. But if you want an even better strategy that makes profit even if the market goes up, down, or in circles, and generates weekly options income, makes higher profit in less time, has a high win rate, and comes with rolling and adjustment options to turn losing trades into winners or break even, then you can sign up for it on my website. You can find the link in the description below. To make this trade in Robinhood, you can go to search and type in triple Q. Then on the right side, click on trade triple Q options. And then we are going to select the expiry date, which is going to be at least 1 year away. So I'm going to scroll down, and June 30, 2026, which is 362 days. So 1 year out. And on this date, I'm going to select a 60 delta call, which is going to be slightly below the current price. So the current price is 555. And if I scroll down to 550, this is where I have a 63 delta call. Now, you're not always going to find a call which is the exact 60 delta. It can be a few points up or down, but it has to be in the same ballpark. And pick the strike with the round figure number, because that is going to have higher liquidity, which is going to make it easy to get in and out. To buy this call, I will just click on this plus icon and then hit continue and select my quantity, which is 1, and enter the mid price. So the mid price is about 60.2 in this case, and then I'm going to submit my order. Just like any trading strategy, this strategy also has some risk, and here are a few ways to manage it. If I buy into this trade and triple Q drops even more without hitting my profit target, and it does not recover for 12 months, then this trade can go to zero. So only invest what you are willing to lose, because a losing trade can potentially go to zero. This strategy is based on dollar cost average. If market continues to go down day after day and it has multiple days where it meets our entry rules, then I can potentially open multiple trades, and at that point I can have multiple active trades at a given time. So you want to size your position accordingly, which will give you the opportunity to average down if needed. If the market goes down again, the strategy can continue to average down. Limit the maximum number of active positions based on your account size and risk profile. Since I can be in multiple active positions at a given time, I want to limit my maximum risk using this strategy. So you want to have a limit on how much capital you can deploy, and you also want to have a limit on how many positions you want to carry at a given time. For me, that limit is about 3 active trades. So if I'm in 3 active positions, I'm not going to enter the 4th one until at least one of them hits the profit target. I'm going to systematically take in profits at 50%, which will lock in profits into the cash reserve. which I can use for the next buying opportunity. Be mindful of major macro events which can result into a prolonged bear market. For example, a recession, or like in 2022, there was a rate hiking cycle due to which the market kept going down all year long. So if you hear the news and you see that something like that is coming, then you want to step aside and wait for a better opportunity. So if you like this video, hit the like and subscribe button and post your questions in the comment. I will try to answer as many as possible.